Today we're going to be using the Noon Finance app to compare how the debt snowball effect affects your net worth versus taking your monthly savings and investing it in the stock market. So the debt snowball method, if you're not familiar with Dave Ramsey, is a method where you take your monthly savings and you allocate it towards paying off debt as soon as you can. So if we look at the balance sheet of this made up person, we've got some assets here, we got some debt here, credit cards, student loans, and an auto payment. These are at 6% interest rate, credit cards at 22%. So if we jump over to the cash flow page, those debts are automatically pulled in. So our principal and interest are $918 a month for all of them. Other expenses are going to add up to about $240 a month. And we've got some variances plugged into those. So this is our monthly savings range. And if we go down to our savings allocation, we've got it set up to put 100% of our monthly savings, so that $840 or whatever, and we're going to pay it towards additional payments on the credit card. And then once that's paid off, we're going to go towards the auto loan, then the student loans. And then once all the debt's paid off, we're going to put it into our brokerage account, which is making 7% a year, plus or minus 15%, I think. So we forecast that out. We're going to assume a 4% income growth and a 3% expense growth over this time horizon. So we can look at 5, 10, 20, and 30 years. And this is what our median net worth profile is going to look like, is this dark line here. So let's now copy this profile. And instead of doing the debt snowball method, we are going to take all of our monthly savings and shove it into that brokerage account that we talked about. So if I go back to the cash flow page, we're going to delete this allocation here, and we're going to say, let's put 100% of our monthly savings into our brokerage account. And as debts get paid off, you can take that extra savings and continue shoving it in the brokerage account, but the debts are just going to get paid off later. So that's the difference between the two profiles. And rather than, and here's your balance sheet over the years, so you can see your debt gets paid off at the end of year 7 in this profile. It was year 3 in the debt snowball one, but let's just compare them straight up. So let's first look at 5 years. This is basically our balance sheet forecast, or our net worth being forecast over a 5-year period. So with our debt snowball method, it looks like we end up with a slightly higher net worth. And our bands are going to be a little bit tighter, so that means there's less variation in the simulation results. If we scroll down here, here's our debt snowball profile, and here's the heavy market investment one. It looks like the debt snowball method, after a 5-year time horizon, you could add a debt here, whereas you're still in debt in the investment one. Your forecasted liquidity is going to be higher when you're investing versus paying off debts. And then your range of likely net worth, it looks like it's going to be similar, but the low end is going to be higher when you're paying off debt aggressively. And then it looks like the net worth is going to be a little bit higher when paying off debt. Let's look over a longer time horizon, say 10 years. And I'm just going to skip right down to the results. So we get our debt paid off in year 8 for the investment one. Our liquidity is a little bit higher for the snowball method. And then it looks like the debt snowball method is really pulling away here. The lower end of our net worth projection is significantly higher than the lower end of the market investment one. And I expected the upper end to be higher for when you're investing in the market. I thought there'd be bigger upside, but it looks like here with the debt snowball one, even the top end is higher. So paying off the debts looks like it is to be the winner. Now, that's not a conclusive, Dave Ramsey wins kind of conclusion here. This is heavily dependent on our balance sheet and the interest rates on the debts, as well as the assumed rate of return for that brokerage. So if you're not getting those returns, and if your debts are higher, or if debts are lower, then you may get different results. But for the made-up scenario that you saw here, I'm going to say that the debt snowball method beats putting your savings towards aggressively investing in the market. Let me know if you've got any other scenarios that you'd like me to run in this software. It's pretty cool being able to compare the different scenarios. So next we're going to look at buying a house versus renting a house and how that affects your net worth over the long run. So thanks for watching, and let me know if you've got any more ideas that you'd like to suggest.